Hey everybody, it's Ken Himmler again. Welcome back. Today we're on part three of how to reduce or eliminate your capital gains tax. And in parts one and two, we covered how to time your capital gains tax to get into the 0% tax bracket. In part two, if you haven't watched these on YouTube, just search for my name, go to the channel, One Wealth Map, and you can find all of these videos. So if you want to watch them from beginning to end, we're on part three today. Last time, part two, we covered how to use paper losses to bracket ladder up, to basis ladder up. And today we're going to talk about pure loss harvesting. I know this stuff is about as exciting as watching paint dry or hair grow, but it can save you tens of thousands, if not, depending on where you're at, millions of dollars over your lifetime if you understand how this system works. In part four, we're going to cover the 664 trust, and in part five, we're going to cover strategic RMDs, hidden taxes, and Roth conversions. So without further ado, let's get on with today. And we're going to talk about how losses are netted out. Now, if you watch part one, I went through all the basics, but it doesn't hurt to kind of go through it real quickly. Not going to spend a lot of time on it. So basically what you're going to do is at the end of the year, right now, you're going to look at where you're at. Net out your short-term losses and gains, net out your long-term losses and gains, and whatever that net is what your short-term or long-term gain or loss is going to be for the year. Now, the rules on loss harvesting. Well, the first thing is when you sell an investment, you cannot buy the same investment back. So you can't just sell it on Monday, on Tuesday, you buy it back, and then you book the loss. You have to hold it for 31 days. And for all of you that are out there that are super creative, and you're saying, yeah, but I know what I'm going to do. I'll buy a call option on that stock right before I do it. And that way I protect the price from going up in case I'm trying to play this tax strategy. Well, it doesn't work. You cannot buy any hedges or derivatives off of that stock either 31 days prior or 31 days after. Now, you can use similar investments, just not the same investments. And I'm going to give you an example of that because it's actually pretty simple. A lot of people, they read into this way too much. Here's the example. Let's say that I bought 1,000 shares of Microsoft 2023. And I bought it at $530 a share. And let's say that right now, so that'd be $530,000, right? Let's say today it dropped to 450 bucks. These are examples. Obviously, the prices aren't accurate. I'm giving you this so you understand it, this example. So now you've got an $80,000 loss, right? Because the share price dropped from 530 down to 450. You got an $80,000 loss. What do we do? Well, step one, we're going to sell all the shares for the $80,000 loss. We're going to book that loss. You got to sell it to book the loss. Well, we're going to go back and we're going to buy something similar, but not the same. Now, when I say similar but not the same, so would a Russell 1000 be the same as a NASDAQ 1000? They're pretty close. They track pretty close. One is a little bit more volatile, but they track, meaning when the tide is coming in, they kind of both come in. When the tide goes out, they kind of both go out. So if the goal is to not be out of the market, and we know that statistically, there's if you're out of the market one day out of every single year, 1 week out of every single year, you lose that opportunity when the market actually comes back. So you cannot time, you can time the market, but statistically 99% of the time people don't make money doing it. They end up losing because they don't know when to time it. No one has a crystal ball. If anybody knew how to do that, then they'd have all the money in the world, right? But they don't. So, well, unless you're an inside trader, but then you go to jail. So you're going to buy something that's similar, but not the same. So you can't rebuy Microsoft. Could you rebuy Nvidia? Yes, you could do that. Could you rebuy Facebook? Yeah, you could do that. But again, maybe this is just a play where you're trying to book the loss and stay out of the market long enough, but you're not losing out on the uptick. So maybe you buy something that tracks in a similar manner. So again, it can be, say, an ETF that tracks high-tech stocks. It could be an index like the NASDAQ 100 or the ones that will track those high volatile stocks. So anyway, you're going to get back into the market. You wait 31 days. Now, if you want to sell whatever your replacement vehicle was, then you can do that. So I'll give you a great example of that. We just had somebody that came into our office, and interestingly enough, they did this without even us helping them. So they went in and they bought Rivian. Oh, I don't know, whatever, whatever it was, 6 months ago, and they bought $135,000 they bought $135 per share. Well, now it dropped to $10 per share. So they didn't see that moving anywhere. So they came in, they had sold it, and then they waited 31 days and they rebought it. I think that was a smart move because they took a massive, massive tax loss, right? So they took $120 some thousand tax loss, and then they got right back into the stock, which is very wise because now you can actually use that stock loss against anything else that is a gain. So what are the benefits of this? Well, we're going to use the $80,000 in total loss available. Now, assuming there's no other gains, right? So we can actually take $3,000 as a deduction against our ordinary income. Now, this is where it gets mixy. Mixy meaning people get mixed up because they hear one version of something that they've read on Dr. Google or Google Financial Advisor, and it says, if you take a tax loss, you can only write off up to $3,000. That's not right. You can write off the entire $80,000. You just may not be able to do it in one single year. You might have to wait until you have a gain to offset the loss. During that period of time that you're waiting to get that loss, it's a great benefit. Why? Because it didn't cost you anything. You didn't physically lose the money, right? Because you came out of the position, you went back into the position in 31 days, and you utilized something that was interim similar to make sure you're not out of the tracking. So now you get back into the stock. Well, you got an $80,000 loss, and you can use that against anything you want, right? So in the Rivian example, if that goes up from $10 back to $135 a share, they've got that loss. They can still offset that loss. But in this example that I'm giving you today, we're using Microsoft. So you can use that $80,000 loss against anything. And if you don't have something to use it against, you can continue to take that that $3,000 loss against ordinary income. And that's a benefit because ordinary income tax is a much higher tax rate than capital gains tax. And if you remember, if you play it right, there's things that you can liquidate and go back to part one of this and stay within the 0% tax bracket. So whatever you don't use, so if you take the $80,000 loss and you use up $3,000 because you didn't have any other gains, guess what? You can carry forward $77,000 until the next year. So it's a really good deal. Now, if you have other gains, again, and you're trying to do basis laddering, refer back to part 2 of this video educational series. And remember that that gain you can use against any other gain. So it doesn't have to be against a stock sale. Now, you cannot use it against ordinary income. So you can't use it against a Roth conversion. You can't use it against an RMD, but you could use it against another stock sale. You could use it against a real estate sale, and you could even use it against a business sale. So that's a huge benefit. Now, in the next version chapter, episode 4, we're going to cover how to use the 664 trust. And why do we use 664 trust? Well, because the problem is that people don't always prepare enough and they get caught, right? They'll call us 6 months from selling their business or 6 months from selling a house or a rental property, or they want to call us and say, I'm nervous about the market. What do I do right now? And they want to sell, or they sell. What's worse is they sell. We just had this instance where we tell every single client, before you do anything at all, don't just do it. Call us and we'll do the calculations. That's our job. And then we can give you alternatives. Well, this is a newer client, only been under our umbrella now for about a year. And we just had one of our financial planners meet with them literally last week. And the client says, well, I just sold my house. I got about an $800,000 gain. I'll be able to roll that into the new house. No, you can't. Each person has a $250,000 or $500,000 exclusion, and you had an $800,000 gain. Had you called us, we could have maneuvered that through a rental property exchange system, even though it was your personal rental property or your personal residence. So in short, if you have somebody like us, make sure that you're working with them before you make any transactions, because this is why sometimes the only way we can save people's bacon is by the 664 trust. Because when we use the 664 trust, we can contribute any kind of property. It could be real estate, it could be land, it could be a business, it could be stock, it could be bonds. There are certain things that aren't as beneficial to add, such as an IRA or such as an annuity. It can be done, but those places that are not tax deferred are definitely going to be the sweet spot. So we can't contribute anything. what that does by contributing to a 664 trust, it'll zero out our capital gains tax, and we actually get a tax deduction for actually